Well, welcome to our High Rock video. We shall call this our Halloween edition, so I will warn you in advance that there may be some scary stuff in this presentation. Well, I'm Scott Tomlinson, and my partner and colleague and the founder of High Rock, Paul Tepsich, is traveling today, but we wanted you to have a quick update. Bianca Tomlinson, our certified financial planning professional, is also with me on the call. Well, last June, I updated you all on the status of where we are currently in the economic cycle. The Trump tax reform had given a positive bump to US GDP, pushing up second and third quarter GDP levels. Well, that has given the US Federal Reserve the necessary rationale to push interest rates higher, which is tightening monetary policy and will have a slowing impact on future economic growth. Well, fourth quarter growth is now expected to slow to a 2.6% annualized pace. The Canadian economy has also seen an uptick, and the Bank of Canada has also been raising rates. So how has this been impacting our portfolios? Well, with higher rates, we've seen falling bond prices. So for the time being, that means that falling bond prices, when marked to market in our portfolios, will push down the total portfolio value. But as we mentioned last week, this is a temporary situation, and as we have suggested in the past, bonds will mature at the same price that they are issued at. If interest rates go down, bond prices will rise. When interest rates go up, bond prices will fall, and these moves will impact your portfolio's total value for the time being. However, bond prices mature at their issue price, so no matter the price swings, they return to their original value unless we sell them in the meantime. Currently, any bond losses in your portfolio are unrealized, and as long as they are left to mature, will return to their issued price. Well, slowing economic prospects, higher interest rates, and global geopolitical uncertainty have pushed global equities lower this year by 13%. What happens next is not necessarily clear. The fourth quarter traditionally has been good for stocks, but the technical picture may demand that investors have to endure further declines as the bull market trend gets tested for buying support, which comes in first at the 200-week moving average at about 6% lower, and the long-term bull trend line, which is another 5% lower. So we could continue to see some volatile trading. We are positioned in our global equity model with underweight holdings in equity and plenty of cash equivalents, which is the only asset class that has not been going down. This is a function of where we are in the economic cycle. The Canadian stocks have fallen 13% since September, already breaking the 200-week moving average. The bull trend line is another 10% lower. So, fixed income prices are lower, global equity prices are lower, and Canadian equity prices are lower, which does impact our tactical model. However, we have significantly more cash on hand for defensive purposes and future opportunities. That is our disciplined investing process. We will return to growth as we move into the economic cycle that will eventually evolve, as it always has done. With more cash to put to work, that should allow us to hopefully reap the rewards of buying at lower prices, which is what we have been waiting for. That will also give us more growing power in our models and portfolios. For now, we need to be patient. We are in this with a long-term approach, and we will get back to target or above target growth to keep us all in line with our wealth forecasts. Well, that is it for this week. Thanks for taking the time to tune in. We certainly appreciate any feedback and want you all to feel free to send questions via email or call us. Until then, we hope you have a great rest of the week and a happy and not so frightening Halloween.